I'm heading the EMEIA real estate group of Ernst Young, which means Europe, Middle East, India and Africa. And I'm trying to give you a 10-minute introduction just on the financing side. And there are a couple of items I would like to talk about. What's the size of the market? How troubled are these loans? What's happening with deleveraging? Are we seeing any distressed loans? What is the alternative financing? And then the million-dollar question, if you can get financing today, what are you paying? So if you start with the size of the market, there are a lot of figures out of there, and nothing is totally accurate, but the estimate is something like 2 to 2.5 trillion euro of commercial real estate loans, which is roughly 10% of the bank's book. And whatever study you take, a significant part of that is delinquent, is underwater, whether that's 700 or 800 billion or whatever. And a lot of that debt also originated before 2007. And a lot of that debt is also held on the books of the banks at carrying value, the cost price. So those loans are hold to maturity. A lot of them carry margins which are below today's margins. So if you would fair value them, they would have lower values. But because they are under IFRS, International Financial Reporting Standards, treated as hold to maturity, they are at higher prices. So if you look at refinancing, this is probably a very familiar statistic as well. Again, there are many estimates, but out of that 2.5 trillion of loans, something like 1 trillion is up for refinancing in the next years. And roughly that's 25% this year, 25% next year, and it runs on. And obviously the big question is, who is going to refinance it? Is it simply going to be rolled over? Is more equity needed? Is there a funding gap? And who is then going to step into that funding gap? And as I said, a part, or maybe even a significant part of those loans may be underwater, either because the LTVs, too high LTVs, too low margins, or the quality of real estate. And the combination of the three is a deadly Molotov cocktail. To make it worse, and that's also very well known, there's a lot of deleveraging going on of banks. Due to Basel III, also maybe risk aversion. Banks look today a little bit less favorable to real estate than they did before, or even more worse than that. But nevertheless, I mean, Basel III is asking them for more capital. They have to increase their Tier 1 ratio from now until 2018 until 9%. And to sort of fade out existing equity instruments like hybrid instruments which count today for equity will no longer count for equity in the next year. So there's a lot of deleveraging going on. 2 years ago when Basel III was announced, Morgan Stanley said that the banks had to recapitalize for 150 billion euro of more capital. Whether it's true or not, a couple of weeks ago I heard a figure which was 10 times as high, 1.5 trillion. And again, I mean, I'm not a banking specialist, I'm not sure if that is correct, but if you look at studies of IMF, which basically says that the banks have to decrease their loan books by 10%, that's also pretty close to this 1.5 trillion. So either they have to ask for more capital, which increases the cost of capital and increases the cost of lending, or they have to deleverage. And in reality, it will be a combination of the two. So there's a very interesting study out there which is published every half year of DTZ, which is basically calculated that there is a funding gap. And the funding gap for the upcoming year, upcoming period, is something like 200 billion. They expect that something like 75 billion will be made available by alternative financing, be it the debt funds, be it the insurance funds, whatever, and the remainder could just be fulfilled with equity. So that's basically still quite optimistic. So a funding gap on one side, but equity available on the other side to close the gap. So if there is alternative financing around, what is that alternative financing? Well, the talk of the town is obviously insurance companies. Everybody says because of Solvency II, insurance companies step into real estate loans whether it's totally true or whether they just think it's attractive to go into good quality loans with relative high margins. Again, the truth is probably in the middle, but they're stepping in. But certainly not in the massive amounts as needed for the refinancing. As Mr. Piani, CEO of Allianz Real Estate, once said, we don't at all have the illusion or the objective to close that funding gap. We're just picking the nice loans with the high margins. So there is financing made available by insurance companies, but it's a drop in the bucket. Another thing what we are seeing is over the last 2 years, a lot of private placements from the US, also a lot of corporate debt funding, but unfortunately that's almost exclusively available to the REITs, the Unibals, Rodamcos of the British Lands of this world, with a good balance sheet, with a good track record. That market is to a much lesser extent open for non-listed listed companies. And then we have the debt funds being set up also by insurance companies or banks. They're also there in the market. So there is some alternative financing around. Is it enough to close the gap? Many say no, future has to prove. Another issue obviously is, if so much of those loans are underwater, are we seeing a lot of distressed debt? And I already said, the talk of the town is insurance companies stepping into real estate lending. Another big question is, when is all this distressed debt coming to the marketplace? Studies out there say already 30, 40 billion has been made available. Others say there's even more, but it are secret deals. They are not announced in the marketplace because banks don't want to shout loud and clearly, I'm here to sell off loans with 30, 40, 50% discounts, because that's the sort of discounts we're talking about. Another thing is that there are banks which are in a controlled runoff. So yes, they are stepping out of real estate, but not at any price. They take 3, 4, 5 years. And what doesn't help, at least if you're looking for distressed debt, is the low cost of capital and the liquidity provided by the European Central Bank. So everybody expects it's coming. A lot already has been brought to the marketplace, but a lot is expected to come. But that's already been said a year ago as well, and we don't see it in those massive amounts as everybody expected. Finally, if you can still lend, and I just called this messages from GRI. There were a lot of good panels which shared information on what is the cost of lending today, and these are just some facts and figures from GRI, but also what we see, what our clients do. Actually, those figures appear to be fairly correct, at least if I look at my own clients or talk to the banks here or whatever. So the first thing is core loans, 200 to 50 basis points. In reality, some of the deals are already closed below 200 basis points. Why is that? It's just like real estate. In real estate, everybody's chasing for the same asset, the super prime, and the same thing is happening on the lending side. So the banks and the insurance companies, which are still there to make that available, are looking for the super core, and that's why margins are decreasing there. But beyond that, it gets really ugly. Even if you have a good, well-tenanted property, but it's not super core, you already pay 100, 150 basis points more. If you are a newcomer to the market, it's almost impossible. And if it's possible, you probably pay 600 basis points. A lot of those loans are warehoused and subsequently syndicated. And what we also see, the quality of the lender is becoming increasingly important. If you don't have a track record, if they don't know you, even if it's a very good product, it becomes very difficult. So the expectations are still pretty gloomy. Some say this crisis lasts 10 years, we're 5 years down the road. Are we at the bottom or not? Well, from the financing side, many people think it's not the case. We are moving to LTVs of 35 to 45%, which is significantly below pre-2007, when 70, 80% was available. And what does that tell us about real estate? I mean, everybody's talking about property shocks as they are being used in Solvency II. But if people only want to lend with 30-45% LTV implicitly compared to the old 70%, you factor in a property shock of 35%. So people just don't trust real estate valuations. That's what we still see. And will this ever normalize? I hope so, I think so, but people think this is taking another 3 to 5 years. And in the meantime, it's still a difficult market, and all that alternative financing available, just mentioned, insurance companies, whatever, is just a drop in a bucket. And we have, at least from the refinancing side, 4 very difficult years to go.